satisfied otherwise.
Any other questions? Yes, please.
Good afternoon, Professor Joko. I'm Marie, and I'm the founder of MDW Consultancy. I spent 7.5 years of my life in China, so I just want to share some of the observations. I did agree with some of your, or most of your comments that you had presented on the Chinese market, but just want to also share 4 other points. First of all, the residential property market actually started around 2004, 2005, and therefore, now that it's 10 years later, it cannot be really compared with the United States residential market, where it is very, very well established. So that's point number 1. I suppose with China's economy and property market going forward, and taking a lead from other countries, including Singapore, hopefully it will be able to document the property market cycles so that it's not going to be of too much boom and bust in that aspect. Secondly, with due respect to the Chinese national friends here, very often the price indices in China, they have maybe 2 or 3 sets of the same indicators. So it really depends. I mean, again, with due respect to the National Statistics Bureau, so for example, it's very, very well known that there's this tracking device of 70 cities for which the residential prices are often widely commented on a month-to-month basis. But frankly speaking, when I was based in several cities in China during those 7.5 years, sometimes the underground activities don't quite tally with what is being reported. For example, price may have dropped by 2%, but then when you go around the show flats sales galleries, somehow the feel is very, very different. So again, there may be a different set of agenda where on the policy making side, the officials have to toe the party line, and therefore the results of the index could be really different from what's on the ground. Thirdly, in terms of the price to income ratio, this is really interesting because, again, we all know that there is the other undeclared income aspect. So again, it really boils down to what kind of income you're reporting. Very often, of course, for official reasons, it's underdeclared. So in that regard, the analyses can be a bit distorted. Yeah? And lastly, again, for residential land prices, I just want to also clarify, because we have the 70-year lease versus the 40-year leases. So 40-year leases, will be the mixed-use development sites, and therefore you can't really compare like for like, because 70-year leases will be for pure residential sites. And lastly, I think to address the gentleman from Savannah, Jurong, on the non-residential or commercial sector, there is definitely an oversupply, but I think, again, this is because of the emerging property market in the past 10 years, where you have 40 or 50-year leases for mixed-use development sites. So developers have actually jumped onto the bandwagon and developed a plethora of office, retail, hotels, even business parks, factories, industrial spaces, warehouses, whatever, the whole gamut. Even Disneyland Universal Studios will be in oversupply as well. But I think it's also tied to the policy of, in Chinese, there's this thing, it's called 楼宇经济, which is actually the building economy. So then again, it's what I'm trying to say is that the property market is really entwined or intertwined with the policy making. So in that sense, that's why property market revenue, or even land sales for that matter, actually comprise, I wouldn't be surprised, maybe 30% of the city's GDP growth. So again, it's a very unique market in China because the property market is not a standalone segment on its own, but it's actually intertwined with other policies in the country. Thank you.
Can I just real quickly respond? So I think we agree. The gray income point is well taken. So true price income ratios are lower because of gray income. I couldn't agree more on the short time series. It is what it is. I also, the reason I showed our constant quality land price index and no other data is exactly your reason, because we don't believe the other data. So I think data quality, particularly from a number of government series, is suspect. All of our land price series, everything you saw is for pure residential 70-year leasehold estates. And I couldn't agree more. I should have mentioned this in the talk. I think the other important consequence from any slowdown in property, and I'm pretty sure you're going to see a drop in quantities, is the direct spillovers. And I think that's part of the unraveling of the commodities boom and the like. As you build fewer homes, housing units, you don't need as much lumber, steel, this, that, or the other. That's the biggest spillover in the Chinese economy, and I should have mentioned that. I absolutely agree with you.
Okay, next question.
There's one in the right.
Oh, yes, please.
Hi, my name is Gail. I work for Host Hotels, which is a U.S. REIT. With regards to employment growth, you mentioned that you felt that employment growth in the states that's picking up is going to be more sustainable. However, in light of the recent Q3 corporate results in the U.S., it's not been proving very, very optimistic in there. And is it a case of employment growth in the U.S.? I mean, you would say that the unemployment rate's falling, but employment participation is also falling a lot, and that's often something that's kept on the side, it's not mentioned. So that's my first question. The second question is on equity capitalization in the Chinese banking system. While the banks might be, in that sense, not so, might be better capitalized than the U.S. before the GFC. What about the shadow banking system in China? Yeah, these are my two questions. Thank you.
Okay, so the U.S. Well, let me start with the easy one. The shadow banking system in China. Yeah, the banking system's opaque to me, so I can't tell you what I think. I don't know about what the real shadow banking risks are. I hope someone in China does, because the bad news in the U.S. was our regulators and the banks themselves didn't understand the risks of our shadow banking activities, so it can be a real problem, and we proved it in the United States. So that's in terms of the overall banking system, though, when I count up officially, counted reserves, they could bail out a large deficit in China. So the national balance sheet looks strong enough to deal with even a major collapse. That wouldn't be a good thing for China, but on the U.S., the employment rate, you're exactly right. This is why the U.S. labor market, I think, is sustainably healthy now. What do I mean by that? I think we're going to get 2 to 2.5 million net new jobs a year for the next 12 months. That's not wildly robust compared to past booms, but I think we're going to get it. And I think we're going to get it even with weakening corporate profits. What's happening to for U.S. firms, I believe the following is true. My colleague Jeremy Siegel, who studies this stuff, I may misquote him a bit, but not much. If you look at the S&P 500 firms that are U.S. domiciled, something like 50% of top-line income revenues comes from overseas. Okay? And what do we know is slowing? Overseas growth. So one would expect their corporate earnings to go down, but that doesn't mean their U.S. employment's going to go down. What I think is going to happen, and what is happening, is U.S. manufacturing employment is starting to dip. But manufacturing is such a small share of our employment base, I don't think it's going to overwhelm the growth from the services side. So I see modest employment growth going forward, and the basis of my belief, which could be wrong, but I believe it anyway, is that the deleveraging household sector is going to allow for fairly modest but stable consumption growth, and that's close to 70% of GDP in the U.S. This is what China's trying to do, is generate internal growth that will just drive from the household sector. The good news is we've done it, and we're now deleveraged enough. I think that will carry the day. Now, I could be wrong, that it's not as strong as I think, but I think that will carry the day, and I think that will be good for hotel occupancy vacancies in the US for Host and your competitors also. But I'm not calling for something wildly robust. If you look at the employment chart I showed, employment growth is still weak compared to the 80s and the 90s, and that's your falling participation rate. What we've seen in the United States is particularly middle-aged, lower skilled males, which I'll define as high school grads and less high school dropouts. They're dropping out of labor force permanently, and that's the decline in the participation rate, and I don't think they're coming back. There was a couple of others, yeah.
Yes, please. Behind.
Good afternoon, I'm John. I'm not for the real estate, so I'm going to ask maybe a little tangential question, and I hope you entertain my comments. My little mind tells me from all the story you've told us that there's a lot of known unknowns, a lot of unknown unknowns in the real estate market. And the real estate thing is a very interesting thing to me because it's the only estate that's real. Okay? Unfortunately, a lot of the money that go into the real estate is unreal. So the cycles is the only predictable thing about the real estate market. But the most unpredictable thing about the market again is when it's going to boom or bust. Nobody can tell. But it will definitely go up or down, up and down. The swing is always there, right? So I'm glad that you're doing a lot of study and work to help to make things more known, so that at least people are more aware of things rather than completely unaware. There's one thing I think that governments, regulators, professor cannot really manage is human behavior. There's a very fine line between, a lot of people go into real estate based on sentiment. And when it comes to sentiment, there's a very fine line between confidence based on a lot of rationality and studies, and that hopeless. So it's a very interesting, perplexing market. Obviously, that's why it draws a lot of attention into this market compared to, say, even bond and work, employment, industrialization, and all that. So I'm not sure what to think of the whole real estate. It's a little unreal. But then again, if you look at the Piketty's book, right? It's obviously the real over the last 300 years. So I'm still quite not sure what to make of real estate. Your comments, please, Professor.
Well, I think your momentum comment is exactly right. There's clearly momentum investing. I think this is part of what Dr. C was referencing. There's some type of momentum / yield chasing. It's just a different term for what goes on. So I agree, and some of it, we had a discussion on, is it rationally based or not? Is it soundly based? It's hard to tell. I could come up with rational explanations, but I think we both agree they're probably overpaying today in many U.S. markets and would be disappointed by the returns. And I don't think we're ever going to reach a point where we can predict the timing of the cycles. And the reason they occur for reasons we only recognize ex post. Just look at the United States. Nobody thought that Bear Stearns and Lehman Brothers would collapse when they did. These were firms that survived the Great Depression in the 1930s. These were old, venerable firms in the U.S. They grossly over-levered themselves, and they couldn't survive a much less severe downturn. And it turns out the counterparty risk associated with them was so severe it froze the capital markets temporarily and sent us on a downward spiral. Anybody who says they thought that was how the crisis was going to start, nobody thought. And that's what it'll be in China. It will be something we don't recognize that it's your human beings are funny animals point, which is, if they were that predictable, we'd all be rich because we all get the prices right all the time. So that's not going to change. But by the way, that's not peculiar to real estate. That's true in stocks and bonds also.
Right. We have a question in the middle there. Even the back cross there.
Hi, Professor. I'm Jasmine from MAS. So, I guess your question is how should governments and private developers manage real estate cycles? And your first few slides showed that it is a common occurrence across all property markets. Well, I have my first question is in the United States itself. What is regulators' experience with implementing housing-related macroprudential measures, or are there practically none at all? I'm talking about things like the loan-to-value and debt-to-income ratio or stamp duties.
Yeah. So in the U.S., we thought about doing that in recent mortgage regulation. We have something called a qualified mortgage rule, which gives, it's going to get technical, it gives banks safe harbor if something goes wrong with the loan, if they met certain underwriting standards. And due to a bunch of politicking, the standards got written in such a way that there's not one word about loan-to-value ratio or anything like that in the qualified mortgage rule. So we punted on that. My personal view is we shouldn't have. I believe this is where the Chicago economist believes I think there's a legitimate role for governments to worry about leverage, particularly if they think it can be systemically risky. And housing is such a huge part of our asset base. It's not hard to imagine the Federal Reserve would think a massive collapse would cause systemic risk in the financial system. But quite frankly, we continue to have virtually no experience with it because we decided not to go down that road. Now, I do believe we're starting to move towards something I do find quite sensible, which is increased capital requirements for our banks, and particularly bigger capital requirements for big banks, which are too big to fail. That I've said, equity is the ultimate shock absorber for all downturns. It's what stops runs. Equity stops runs from turning really dangerously bad. So that's the way, since it's pretty clear to me, we're not gonna go into the housing market and regulate LTVs through macroprudential regulation. I hope we have the will to tell the banks, you're gonna have more equity than you had last time, because that could save us all if they're well capitalized.
So I have a follow-up on that, which is that I suppose equity allows banks to withstand gyrations in your property cycle, but may I suggest that macroprudential measures targeted at the housing market do help to dampen the amplitude of these cycles themselves?
Sure.
Yeah, so for instance, if we have a debt-to-income ratio, your maximum mortgage that you can take out doesn't increase as the price of the property rises.
Yeah.
Yeah, so it basically makes your demand curve more inelastic. So on that point,
I agree, and so China had a severe price collapse in China will not have nearly the negative effects it did in the U.S. simply because of the equity cushion at the household level. I agree completely.
So can you help me to understand what is the aversion amongst regulators in the U.S. towards these kind of measures?
Well, I don't think it's, well, I'm never running, I'm not a politician, so I'll say something in politics. I don't think it's the regulators. I think it's the lobby from the home ownership groups which prevent the regulation. I think the regulators would actually like to move in your direction. It's just the political forces in the U.S. won't let them do it. That's my gut.
Thank you.
Okay, there was a question here? Yes, please, go ahead.
Richard Lai from Fogoland. I actually wanted to say something in respect to the views that you have, which is that you think that the government should regulate the banks as opposed to regulating the market directly. And then there was this whole conversation you had with the central banker just a moment ago about something to that effect. Only thing from the angle that the government should continue to have a rather direct effect to the housing market. I'm actually of the view that less government intervention is actually not necessarily a bad thing. And I think the issue is how and what's the best way of doing so. Coming back to the main point is that how should governments and private developers manage real estate cycles? I think the key to it is information and how transparent that information that you have in terms of the supply segment, in terms of the potential demand, population cycles and demographics and so forth. And that allows a lot of private developers like ourselves to be able to figure out whether or not the oversupply situation is going to happen or not. Singapore is already quite good in the sense that you can, through the help of URA and things like that, you can look ahead in the next few years. But in a lot of the other markets, especially like China, you'll be a bit hard pressed to find out, okay, what's the supply situation going to be like. The other point that I have a little bit of apprehension about asking for equity alone to be that buffer. I mean, well, I can understand why. Equity comes with a price, and for most of your banks, they're all listed. It comes with a certain increase in pricing simply because it gets more expensive to run a bank, and the profitability levels drop because a lot of this equity is just being used as buffer to create a more robust bank. In a world where we are today, thanks to the US government, we have lots of liquidity in the world today. Everybody is chasing yields. So to a large extent, if you have a very liquid market, there's no saying that I should put money in the bank just so that I could end up with the same level of profitability. Instead, I will pressure the bank to do more with the money, right? Whether it's in consumer market, which is traditionally where most of the banks will go to, or to lend to some other just as risky commercial proposition. So I'm not entirely sure that at the end of the day, just equity alone will help the situation in itself, because we haven't actually included the cost of equity into that equation.
Yeah, no, I agree. Nothing's free, right? There's an opportunity cost to equity, but remember, you get more safety. So it's not just a cost. You get more safety, and we just. I used to be much closer to your minimalist view before the U.S. crisis. It is clear to me the banking system is systemically risky, and you can't let it collapse. The thing we learned in the 1930s was you can't run a modern economy without a banking system. And we let ours collapse in the 1930s, and that was largely why that crisis was so much more severe than this one. But it was very costly for us to bail out, and it wasn't just the cost of bailing out the banks, it was all the massive unemployment that was associated with the freezing of the capital markets. And I think slightly lower return, modestly lower returns for banks are an okay price to pay for not having to incur that cost in the future. On the information front, I couldn't agree more. I think if you ask Young Hing and I why we work so much on China, it's because we actually think there's a great social value in putting out better data. There's huge, just think of the price China and the world are paying for the opaqueness of their data. The uncertainty cost in asset prices is huge because nobody quite knows how many units have really been built in Chongqing. Well, we made an estimate in a paper, and it was unbelievable how many assumptions we had to make because they don't tell you how many units have been built. Now, you may like our assumptions, you may not like our assumptions, but you'd have to make them too. So I think it's very important to get better data. But again, I don't think better data solves everything. And it's the human beings are funny people. We had good data in the US, we had transparent securities markets, and we still went nuts. That's my problem. That's why I think prudent regulation is there. I'm okay with it. I prefer a more minimalist approach, which is why I like equity. That one's easy to understand, and equity is a shock absorber. But I couldn't agree more. They're quite legitimate ways to look at housing markets and the like where I could see quite sensible regulations. But I think governments tend to go too far. And again, get a copy of the Dodd-Frank bill and try to read it without going to sleep. It's really, really hard, and I have no idea what half of the regulations mean. So, yeah, I'd rather have a simple, minimalist approach than that.
Okay, next question. Yes, we have one question in the corner.
Hi, Professor. My name is Jonathan, and I work in the government. Can you see me?
Yes.
So, since we're on the topic of regulation, you mentioned earlier that some governments and some countries could have a stronger argument for regulation because of need to ensure affordability of housing. So, how do you think governments can do that to ensure affordability of housing? And is it through price targets, or is it through targeting some other kinds of ratios like house price to income ratio? And also, we've been talking a lot about US and China, those are big countries. So, on the other hand, small countries like Singapore or small economies like Hong Kong may be much more vulnerable to external shocks, external demand, and nobody can say that Hong Kong is not like a free market. The markets work well, but their housing prices have gone